The Schwab U.S. Dividend Equity ETF is one of the most beloved dividend ETFs around. But year to date has been delivering a disappointing result, losing 9%, while the S&P 500 has gained almost 9% in the same time frame. So I received some comments asking what I think about the SCHD, and some people are starting to think that it'd be better to sit in cash, clipping 5.5% coupons, than investing in an ETF like SCHD that gives you 3.7% in dividends and loses value even. The truth is, nobody can predict the future, and you should do your due diligence before every investment decision. But in this video, I want to give you 9 reasons why you shouldn't let fear and emotions get in your way, and why SCHD is, in my opinion, even a stronger buy now than it was 1 or 2 years ago. Number 1 is you need to see the big picture. I always say in my channel that to be a good investor, you need to be ready to do exactly the opposite of what your instincts are. I believe in this not only because I had to learn it the hard way, but because wonderful investors like Ray Dalio made it a mantra.
Do the opposite of what your instincts are. If you're going to play the game, it has to be the opposite of what your instincts and the crowd says, because the market reflects the crowd. So you want to buy when no one wants to buy, and you want to sell when no one wants to sell, right? And that's emotionally difficult, and probably you're not going to play that game well, because it takes a lot of resources to play the game. We spend hundreds of millions of dollars each year to try to play that game well, and it's a tough game to play well. So I would caution you about the market timing game, but I would say that if you're going to do it in the ways that are uncomfortable, because they're opposite your instincts.
Panicking because you're holding an investment like SCHD that made you lose 10% in less than 1 year is natural. And I'm pretty sure the natural instinct for most of you is to want to get rid of it, either because you're afraid to lose more, or because you're afraid you won't earn enough in the next years. For example, I made the same mistake selling most of my meta stocks at the end of 2022, which then increased over 200% until today. So this is the moment in which you have to focus on the fundamentals of an ETF and not on its price in the stock market. Value and growth stocks grow and outperform each other in different times. Period. SCHD is a value ETF, and this year was the year of growth stocks. In fact, the gains in the S&P 500 in 2023 were mostly due to mega-cap tech stocks. Nvidia grew 183%, Meta Platforms 156%, Tesla 72%, Alphabet 54%, Microsoft 37%, and Apple 34%. So if you follow your instincts, you'd throw all your money on the technology sector that grew already 31% year to date. If you instead manage to do something uncomfortable and follow Ray Dalio's advice, you invest in sectors that have proven a solid long-term return and are even sitting at a good price that is everything but overvalued, like SCHD. Number 2 is don't look at current yield, but at dividend growth. SCHD started with a 3.8% yield in 2012, pretty much like today. But the total income that you receive on your dividends has increased by over 13% per year in the last 10 years. If you invested in 2011, at the end of 2022, the yield on cost for you would be 13.8%. That means that for every $100 you invested in 2011, you'll get now $13.8 per year if you always reinvested in dividends. So when you consider an investment by the dividend income you want to receive, you shouldn't just focus on the dividend yield that you should get today, but also on how this dividend is going to grow in the years if you keep your investment. And if instead you're not reinvesting your dividends, you might wonder how SCHD looks like compared to cash. Well, SCHD still crushed cash, delivering 197% inflation-adjusted returns compared to minus 21% of cash. Number 3, it's on sale since October. Many of the top holdings, including Amgen, AbbVie, Pepsi, Chevron, Cisco Systems, and Home Depot, saw a huge decline in the second half of October, putting SCHD at the lowest price since the last 12 months. One of the reasons was unsatisfying third quarter results. But why did this happen? Here are 6 positions that fell in October. Amgen completed a $27.8 billion acquisition of Horizon Therapeutics on October 6, and the market is kind of punishing companies that recently completed mega-sized deals. In addition, Amgen stock is pretty expensive right now since it went from $225 to $261 only in June. Cisco Systems started declining in September when they announced a deal to acquire Splunk for $28 billion. AbbVie has been facing competition against their drug Humira for several quarters now, but we know it's a temporary situation. Chevron fell down over 10% after acquiring Hess Corporation for $53 billion. So this decline obviously spooks short-term investors, but with a long-term perspective, you should just focus on the growth plans of the top holdings. Number 4 is focus on quality, large-cap stocks with dividend potential. SCHD has a focus on large and industry-leading companies, typically with a market cap of 70 billion or over. It's well-diversified, which makes it an all-weather investment choice that's basically good for all market environments, and if If you look at the sectors, this ETF includes all major industries, including sectors that resist well in case of recession, such as healthcare, information technology, and communication services. Here we can see the sector exposure of SCHD compared to the one of the S&P 500, the Vanguard High Dividend Yield ETF, the iShares Core Dividend ETF, and the Fidelity High Dividend ETF. Except for SPY, the others are all non-high dividend funds. You can see that at the sector level, SCHD is well diversified. No sector accounts for more than 20% of the portfolio, and zero real estate exposure means also that all distributions are qualified. Compared to ETFs like FTVV that have the greatest exposure to technology stocks, SCHD has more allocation to consumer staples, which is a sector that struggled in 2023 and again should signal you why 2023 has been a bad year for SCHD but will change in the future. The portfolio includes large players in the healthcare sector such as Amgen, Merck, Pfizer, large telecom players such as Verizon, which has lost almost 14% in the last year, contributing to SCHD's drop, and is now at an attractive price, consumer brands like Coca-Cola and PepsiCo, as well as energy companies like Chevron. Number 5. SCHD's dividends are safe. We saw before that SCHD's income growth over 12 years has been around 14% annually, with dividend reinvested. But even without reinvesting in dividends, the actual growth of the dividend income over time was around 10% yearly, and there wasn't a single year in which SCHD's dividends declined. In fact, if you compare it to the S&P 500 dividend aristocrats, SCHD never reduced its dividends, while the dividend aristocrats had 3 years out of the last 10 with dividend cuts. The reason the dividends are so stable is, in my opinion, the strategy that SCHD uses. The stocks are first screened based on 3 criteria: minimum 10 consecutive years of dividend payment, minimum 500 million flood-adjusted market capitalization, and minimum $2 million of 3-month average daily trading volume. All the stocks that match these requirements are then ranked by dividend yield. This is the reason why mega-cap tech companies like Apple or Microsoft never qualify for this ETF, and also the reason why you get such a good dividend yield every year. The final decision of which stocks will be finally selected happens based on 4 factors: the average dividend growth over the past 5 years, the free cash flow to total debt, the return on equity, and the expected forward yield. Moreover, the weight of single positions and sectors is kept to avoid any overweight. As you can see, a focus on important financial metrics as well as dividend stability and growth. And what comes out are the 100 best high-yield dividend growth blue chips in America. Number 6. SCHD is better than cash in the long term. Take a look at this graph from the Deutsche Bank. Here are 200 years of inflation-adjusted data. In the last 50 years, cash delivered 0.76% long-term inflation-adjusted returns. In comparison, stocks gave over 6% in the same time period. So if you're wondering if it's better to invest in SCHD or in something safe like bonds and cash investments, ask yourself, what is the fundamental risk of US Treasury bonds? S&P estimates there is a 0.29% chance that the US will default on its bonds in the next 30 years. And what about SCHD? What is the risk of SCHD going to zero? Take a look at SCHD's top 10 holdings, which comprise around 40% of the portfolio. Now ask yourself, how likely it is that all 10 companies go bankrupt and their stocks goes to zero? I would say it's almost impossible. And how about all 100 companies SCHD owns? The odds are really close to zero. So is SCHD actually riskier than cash? Not really, and the upward potential is surely much higher than cash. Number 7, SCHD's dividends have better tax treatment. Since we are comparing SCHD to keeping the money in cash and bonds at 5.5%, SCHD also has a tax advantage. In fact, bond income is taxed as ordinary income, while SCHD's qualified dividends are treated as long-term capital gains. So that means you're gonna get dividends with 15% tax, while the tax rate for bonds is gonna be at least 10% more, considering that the average American tax rate is 24.8%. But depending on your income, it might be even much higher than that. Number 8. SCHD is a true value ETF. No ETF is perfect, but SCHD is a 5-star gold rated by Morningstar, for good reasons. SCHD might not be a good growth ETF, but if you are a value investor, there is probably no ETF that does a better job than SCHD. Its holdings are always highly profitable companies. It has 24.23% EBIT margin, a 15.64% return on total capital, and 17.53% free cash flow margins. 98 out of 100 companies are cash flow positive over the last 12 months, and the 2 that aren't weigh together just 0.52%. Finally, debt loads of the holdings are also acceptable, with a weighted average long-term debt to total capital ratio of 0.49%, comparable to other dividend funds like VYM, DIVB, and FDVV. However, As graded by SCHD and Alpha, SCHD has the highest overall profit and value scores. Now, if you are a value dividend investor looking for income stability and you have to decide between these dividend ETFs, you'd probably go for SCHD. VIM and DIVB show some quality problems, as you can see from their lower ROA and ROTC, while FTVV and SPY are more growth-oriented and trade at higher valuations. Mix this with the valuation of Morningstar, which made SCHD a 5-star gold-rated ETF for good reasons, and you see how SCHD is still a great choice. Morningstar analysts think that SCHD's portfolio will have 10.5% long-term earning growth, which will translate also in at least the same amount in long-term returns. The last reason is SCHD is in a better position than the S&P 500 now. I know it's natural to think that if something is growing, it's worth buying, and if something is losing value, you should sell it. But that's not how it works in the stock market. Buffett always makes example of the guy that buys a house in a countryside, and a week later a real estate agent comes by and values the house half of what he paid. What should the owner do? Sell the house just because of this? Of course not. So, because of the hype for AI, artificial intelligence, among other reasons, the information technology sector grew over 30% year to date. And mostly because of the growth of the so-called Magnificent Seven, which are Nvidia, Tesla, Meta Platforms, Apple, Amazon, Microsoft, and Alphabet. And this, of course, dragged up the S&P 500 with it, which has a strong overweight in these companies. And now everybody's happy because we recovered the losses from last year. But what about SCHD? Well, tech exposure here is just barely 11-12%. And that's why SCHD is actually underperformed the S&P 500 by a long shot since January. The S&P 500 grew almost 9% and SCHD lost 9% instead. Now you have to interpret this yourself and decide if you should sell SCHD, hold it, buy it, or ignore it. You have all the rights to think it won't recover from this year's losses, and you can even be right. Nobody ever knows what's going to happen in the future. But we must acknowledge that this year, slow growth has affected the whole economy, and a lot of investors' money has gone into AI and technology because of future expectations. So I'm not really surprised that value ETFs have slowed down like this, and since nobody can know the future, and I'm not a financial advisor, I'd love to hear what you think about SCHD instead. So write down a comment below for the community, but not before subscribing to the channel so that we can meet again next week for a new video. Thank you so much for watching till the end. You're amazing. I wish you a wonderful evening, and as always, I'll see you in the next video. Ciao.